Hello, my name is Darmawan Wijaya. I'm a student in MBA ITB Bandung. In this opportunity, I would like to explain about risk analysis. To begin, first we need to distinguish between risk and uncertainty. Risk is a situation when there is more than one possible outcome to a decision and the probability of each outcome is known. Whereas uncertainty is a situation where there is more than one possible outcome to a decision and the probability of each outcome is unknown. To develop a precise measure of risk, we need to understand the concept of probability distribution. The probability is the chance that an event will occur. The probability distribution is a list of all possible events and the probability that each will occur. Expected value or expected profit is the weighted average of all possible profit levels that can result from the various probabilities. This slide shows you an example of probability distribution. There are three possible states on the economy: the boom, normal, or the recession economy. We can calculate the expected value by multiplying the probability with the outcome. After that, we can get the expected profit by adding the expected value from each probability. We then obtain the discrete probability distribution, which is a list of individual events and their probabilities and is represented by a bar chart or a histogram. After that, we approach the continuous probability distribution, which is a continuous range of events and their probabilities and is represented by a smooth curve. The expected profit for both projects is the same, but the range of profit and the risk is smaller for project A. This is the continuous probability distribution from the previous example. The probability distribution of project A is higher than the probability distribution of project B, that can reflect smaller risks associated with project A than with project B. The standard deviation measures the dispersion of possible outcome from the expected value. Below is the formula of finding the standard deviation. This is the calculation of standard deviation from the previous example. Using the formula, we can obtain that the standard deviation of project A is 70.71 and the standard deviation of project B is 212.13. This value confirms that project B has a greater dispersion of profit and risk than project A. The probability distribution of many strategies follow a normal distribution so that the probability of a particular outcome can be found by the area under the standard normal distribution within the specific range. To measure relative dispersion, we use the coefficient of variation, which is equal to the standard deviation of a distribution divided by its mean. This is the calculation of the coefficient of variation from the previous example. Using the formula, we can obtain that the coefficient of variation of project A is 0.14 and the coefficient of variation of project B is 0.42. Thus, project A has less dispersion relative to its mean. Each person has a different risk appetite. Some managers may choose the more risky project or risk seekers. Some are indifferent to risk or risk neutral. But most managers are risk averters who believe they must be compensated on taking risks. This figure will tell you about the marginal utility of money. The risk-seeking managers had the increasing marginal utility of money, point D. The risk-neutral manager had the constant marginal utility of money, point C. And the risk-averse managers had the diminishing marginal utility of money, point B. This is the utility function of a risk-averse manager. This figure indicated a risk-averse manager will not undertake the project if the expected utility from the project is negative. When trying to evaluate a company, we can use the net present value formula to calculate the present value of future profit. One method of adjusting the valuation is to use the risk-adjusted discount rate, which reflects the manager's trade-off between risk and return. This is the risk-return trade-off function. The risk-return trade-off is a principle which stated that the return rises with the increase in risk. Low levels of uncertainty are associated with low returns, whereas high levels of uncertainty are associated with high returns. The certainty equivalent approach uses a risk-free discount rate in the denominator and the incorporate risk by modifying the numerator of the valuation model. The certainty equivalent coefficient can be determined as a relationship between the certain cash flow and the risky cash flow. Some other techniques to analyze the more complex situation involving risk are decision trees and simulation. Decision tree is a decision support tool that uses a tree-like graph or model of decisions and their possible consequences, including chance event outcomes, risk resource cost, and utility. Simulation is the imitation of the operation of real-world process or system over time. The simplest type of simulation is sensitivity analysis. Sensitivity analysis is a technique used to determine how different values of an independent variable will impact on a particular dependent variable under a given set of assumptions. This is an example of decision tree for pricing decision. In this example, the firm can adopt either high or low price strategy. We can see from the calculation in this figure that the firm will choose a high price strategy. Decision making under uncertainty is necessarily subjective. Some specific rules are available if the decision maker can identify the possible state of nature and estimate the payoff of each strategy. Two specific decision rules applicable under the uncertainty is the maximum criterion and the minimax regret criterion. The maximum criterion determines the worst possible outcome for each strategy and select the strategy that provides the best of the worst possible outcomes. This table illustrates the maximum criterion, whereas a firm could choose to invest in a new product with a return of $20,000 if it succeeded, or earn a loss of $10,000 if it failed, or choose not to invest with zero possible return or loss. For the invest strategy, the worst outcome is a loss of $10,000. For the do not invest strategy, the worst outcome is zero. The maximum criterion selects the best of the two worst possible outcomes, which is the do not invest strategy. The minimax regret criterion selects the strategy that minimizes the maximum regret of opportunity cost of the wrong decision. The payoff metric below shows the payoffs from the two states of nature and two strategies. To apply the minimax regret criterion, we must first construct a regret matrix. Regret is measured by the difference between payoff of a given strategy and the payoff of a best strategy under the same state of nature. After constructing the regret matrix, we then choose the strategy with the minimum regret value. In this example, the invest strategy has the minimum regret value. Besides the above formal criteria, there are a number of informal methods to reduce the uncertainty. Decision makers could gather the additional information, request the opinion of a particular authority, try to control the business environment, and diversification to reduce the uncertainty surrounding a particular strategy. Investing in foreign securities can give rise to a foreign exchange risk because the foreign currency can depreciate or decrease in the value during the time of the investment. Foreign exchange rate is the price of a unit of a foreign currency in terms of domestic currency. We use hedging to cover the foreign exchange risk. Hedging is usually accomplished with a forward contract. Forward contract is an agreement to purchase or sell a specific amount of foreign currency at a rate specified today for delivery at a specified future date. Futures contract is a standardized and more liquid type of forward contract for predetermined quantities of the currency and selected calendar dates. Risks often result from lack of information. Asymmetric information is a situation in which one party to a transaction has less information than other with regards to the quality of a good. Adverse selection is market process in which undesired results occur when buyer and seller have asymmetric information. A moral hazard is a situation where a party will have a tendency to take risk because of the cost that could incur will not be felt by the party taking the risk. One method to overcome the problem of moral hazard is by specifying the precaution that an individual or firm must take as a condition for buying insurance. Another way to reduce moral hazard is by co-insurance, that is, an agreement that the individual or firm shares a significant portion of a potential loss with the insurance company. That is the end of this explanation. Thank you for listening and have a nice day.